SoFi is down 70% from its all-time high, and in this video, we are going to do an in-depth analysis by looking at the financials of the company, the balance sheet, and using my Excel spreadsheet to see what price you should pay for the company. Starting with the financials, it is clear that this is a growing company, as they have grown revenue between 40 and 60% for the last couple of years. However, analysts are expecting between 15 and 30% growth for the next few years. But this is still a lot of growth, and in their last earnings they increased revenue guidance. Regarding profit, this is an unprofitable company as they are still very young. This is why they have negative net income and free cash flow. In this regard, analysts are expecting the company to make 70 cents per share in 2027, which, if you assign a 20 PE, would make it a $14 stock. This means around 100% upside potential. So far, the financials look good, but the question becomes, can we pay a good price in order to make a good return on our money? In order to answer this question, we are going to use my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis and did low, middle, and high assumptions. Right now, you are seeing 6 numbers. The top 3 are based on net income and the bottom 3 on free cash flow. They mean 2 things. First, that in order to make the desired annual return that I have put in, you need to pay these prices. Second, that if the low assumptions occur, you are going to make a 4% annual return on your money. If the middle assumptions occur, 24%, and if the high assumptions occur, 43%, which is a lot. And on my middle assumptions, I think I made reasonable assumptions, as I have the company growing at 18% annually. Keep in mind that analysts are expecting around 22%, 20% profit margin and free cash flow margin, a 20 PE and price to free cash flow to the company, and shares outstanding change at 1% because they have been issuing some shares. The hard part about valuing this company is obviously their margins, as they are currently negative. But because they have such a high gross margin, between 80 and 90%, I think they should be able to achieve an average of 20% for the next 7 years. The Excel spreadsheet does not address any value to the balance sheet, and this company has an okay balance sheet with $3 billion in cash and $6 billion in debt. However, there are some risks in investing in this company. The ones that I have found are competition, as there are a lot of businesses in the fintech industry, the increase in shares outstanding. Even though they haven't increased shares by a lot, they still have been diluting you as an owner, and you own less of the company. It is also an unprofitable company, which means more volatility and more uncertainty. However, the fact that it's a small business means more upside potential. This is also a company with a lot of growth, great margins, and good valuation, as we have seen on the Excel spreadsheet, and they have a price to sales of 3.4, which is not expensive for such a fast-growing company. Just to put it into perspective, Palantir, which is also a small, fast-growing company, is selling at a 15 price to sales. I personally don't own the stock because I don't like to invest in unprofitable businesses because I find them harder to value. But if you like to invest in this type of stocks, this might be a great opportunity for you. Remember that this is not financial advice and you should always do your own research. I hope you enjoyed the analysis. Let me know what you think about the company in the comments, and I'll see you on the next one.